ECB sets a path for more cuts, but how aggressive will it be? Rates came down a quarter point in the eurozone this week, and policymakers made it clear they will go further. The need to stimulate growth is clear. The eurozone economy unexpectedly flatlined in the last quarter, and that's before President Trump imposes his threatened tariffs on Europe. George Buckley is chief European economist at Nomura. George, some observers were even hoping for a half-point cut from the ECB this week. How far and how fast do you expect it to move going forward?
Well, President Lagarde, of course, scotched any possibility of them having talked about 50. They only debated 25, which I think is right. They are on a gradual path to lower interest rates further. We think they'll continue to do so through much of this year, certainly all of the first half of this year. Maybe they start to slow down and ultimately stop in the second half of the year. The markets are expecting them to cut further, but not quite as much as we are. We think they might go to a level which is possibly on the low side, possibly even slightly lower than the neutral interest rate, but not much lower than the neutral interest rate, because we're still looking at inflation figures which we would like to see come lower, and they are coming lower. I think there's some evidence to suggest that we are starting to see an improvement in the inflation picture. They're much less worried about that now than they used to be.
How much, though, will a neutral, or as you say, even lower than neutral interest rate do to stimulate growth in the eurozone? How much ability does the ECB have to create that growth against this backdrop?
Well, notwithstanding, we don't really know where the neutral interest rate is. It's one of those things which is a fantastic concept, but actually the process of estimating it or understanding where it is, very difficult. We'll find out more on that next week when the ECB publishes its estimates of neutral interest rates. But for the moment, they still think that interest rates are restrictive where they are. I imagine that somewhere in the region of 2 to 2.5% might be a range in which you could argue that neutral lies. But as long as we are above that, then it means that policy is restrictive. It's bearing down on growth. It's pushing down on inflation. And for the main part, we don't need that to be the case, especially when economic growth is looking somewhat sluggish. The surveys have been very weak, and inflation is no longer a concern.
The market, of course, is braced for new tariffs from the US, which could come in at least against Canada and Mexico on Saturday. How vulnerable is Europe?
Well, very. If you look at Europe's trade surplus with the US, you can see why Trump might be a bit concerned about this and therefore thinking about putting tariffs onto European imports into the US. So the impact, of course, of widespread tariffs on the US could be a significant increase in inflation. The impact on Europe, I think the bigger concern right now, and especially with inflation under much better control, is going to be the implications for economic growth. And so far, central banks and governments and fiscal authorities haven't really been able to take that on board. And the reason being is because they tend to only incorporate things when they have been officially announced. And of course, as yet, we don't know what Trump is going to do. So, for example, the next time the ECB publishes its forecast, which will be in March, next week's Bank of England forecast, none of those will incorporate anything about the possibility of Trump tariffs, or indeed the possible repercussions if, for example, European or UK governments decide to do something about it.
You mentioned the Bank of England there, which of course sets rates next week. What are you expecting, not just from that meeting, but the next several?
Well, the next meeting next week, I think, is almost a done deal. You don't get much easier calls than this, I don't think. The market's pricing in almost 25 basis points. If you look at economists, they're all expecting rates to be cut. So it should be a simple and straightforward. I mean, no meetings are straightforward, but it should be a relatively simple meeting to forecast. So 25 basis points from the bank next week. Looking further ahead, I still think that we could see rate cuts at a quarterly monetary policy report meetings at a quarterly pace. And that would mean if you went all the way through to the end of this year, it will be another 1 percentage points off the interest rate. And we think they might go even a little further than that, taking rates down to 3.5%. And of course, we talked about neutral interest rates rates before in the context of the ECB. I think when it comes to the Bank of England, the neutral range is going to be higher, possibly in the 3 to 3.5% marks. So if they cut to 3.5, it would be around, in our view, the upper end of a neutral range.
That was George Buckley of Nomura. You can watch more videos on Reuters.com.